Ray Dalio has been on the wires again this month, and the line everybody's picked up was the one about gold and Bitcoin. And fair enough. But there was a third leg to what he said that got far less attention, and it's the one Friar will spend some time talking about now. That is, hold equities across several countries. That sounds like sensible advice until you try to act on it. Which particular countries? What's the time span? And measured in what money? That nobody tells us. So Friar's built something that hopefully will help me and all of you get a grip on it. And in this presentation, we'll lay out how it works and, just importantly, where it might let you down. One thing before we start, everything we talk about is scored in pound or euro starting point, because that's where most of you live, I believe. I run a second version in Australian dollar base for Jet in my book. These two are not interchangeable, and I'll show you exactly where they diverge. If you happen to use another currency, let me know and I can fix it, fix up the spreadsheet. When somebody says, I've diversified internationally, they're usually bundling three quite different things together and hoping nobody asks which one they mean. The first is domicile, where the thing is listed and regulated. The second is revenue, where the money genuinely comes from. And the third is currency, what your claim is finally worth once it's translated back into your own money. Now, here's the bit that matters. Dalio's argument is fundamentally about currency and about who owes whom. It is not really an argument about which economy grows fastest. So, of those three exposures, only the third and partly the second actually hedges the thing we're worried about. Which brings us to the awkward example on the screen. Roughly three quarters of the FTSE 100 earnings come from outside UK, and a great deal of that in dollars. So if you buy the FTSE specifically to get away from America, you have changed your listing venue but kept your exposure. Thus, you've done the paperwork of diversifying without having any actual effect. And Dalio himself is quite pointed on this. He does not treat Britain as a safe harbour. He names the UK and Japan alongside the United States as facing much the same fiscal squeeze, and points to the long dated government bonds selling off across all three at once. So domicile is not a hedge. Again, domicile is not the hedge. So what is this spreadsheet? 24 countries, 14 factors scored on each, three time horizons, 3 years, 5 years, 10 years, and crucially, one single set of underlying numbers feeding all three. Only the weights change between the columns. What it's generally good for is turning a vague hunch into a written list of reasons we can be argued with about. It forces the same questions onto every country so nothing gets waved through because you happen to like the place. And it makes disagreement productive. If you think I've weighted something wrongly, change the number and watch what moves. That's a much better conversation than two people swapping opinions. What it's not, and Fry wants to be blunt here, it's not a forecast. It orders a list against criteria that I chose. Choose different criteria and you will get different order. It also cannot see inside an index at where the revenue actually comes from. That check is yours to do by hand, ticker by ticker. and anything within about 3/10 of a point is a tie. Don't build a position on a gap that small. 14 factors sounds like a lot, so we grouped them into 4 questions that we would ask about any country over a pint. First, can they pay their bills? Government net debt, net not gross, because gross badly overstates places like Japan and Norway. The interest rate versus the growth rate, and how much of the debt is owed to foreigners. That last one matters more than people think. A country that owes its debt to its own citizens in its own country rarely has the sort of crisis we are worried about now. Second, who owes whom? The net international investment position, the current account, and the net energy balance. This family is the one almost every country screener leaves out, and Friar thinks it's one of the most important of the lot. When the world deleverages, creditor countries do well and debtor countries take the strain. That's the actual mechanism, not GDP growth. Third, what are you paying for it? Valuation against its own 20-year average, expected earnings growth, and the exchange rate against its own average. Please note the phrasing there, its own average. Never compare one country's valuation with another's. A market that is 40% banks and miners will always look cheap next to one that's 40% software, and that tells us nothing at all. Fourth, will it still be there in 10 years? So we're thinking about rule of law, demographics, liquidity, exposure to the AI building boom, and what the exposure adds to what you already own. These are the slow variables, practically irrelevant over 3 years, decisive over 10. Okay, look at the chart. Same 14 factors in every column. What changes is how much each one counts. At 3 years, currency in terms of trade take 27% of the weight, and cheapness takes 11. Over 3 years, you are being paid for the cycle and for the cross rate. Valuation simply has not had time to assert itself. At 10 years, it inverts. Currency drops to 8%. Valuation, institutions, and population climb. And that's not Friar being clever. It's one of the better established findings in the literature. Campbell and Schiller showed back in 1998 that the price you pay explains a meaningful share of 10-year real returns and next to nothing about next year. The practical consequence, and this is important, your 3 year screen and your 10-year screen should not be the same screen. If you build one list and use it for both, you will be disappointed by half of it and you won't understand why. Top 8 in each column. Norway wins all three, and we'll come back to that in a moment because it's partly an artifact of how the data is normalized. Its external position is so extreme that it maxes out several factors at once. The margin is inflated even if the direction is defensible. Beyond that, notice how the composition shifts. The 3 year column is full of commodity exporters and cheap currencies. The 10-year column is quieter. Singapore, Denmark, Sweden, Switzerland, solvency and institutions rather than cycle are factors. Now, the United States finishes 24th of 24 on all three horizons. That's not a prediction. It's not Friar claiming that America's finished, or not in this particular presentation. It's the screen doing exactly what Friar told it to do. I weighted external position and cheapness against own history and distance from the AI building boom. And America scores badly on all three by construction. Importantly, the output is the mirror of Fry's thesis, not evidence for it. Every punter wants to know who came first. However, the more useful question is which countries move a long way between the columns, because that gap tells us what kind of holding a thing would be. Japan, 7th at 3 years, 20th at 10. A very cheap currency now, a shrinking workforce later. That's a trade, not a home for your money. It's fine as long as we know which one we're buying. Brazil, 2nd at 3 years, 13 at 10. Commodities and a weak real give it a fine near term. However, their institutions simply don't carry it the distance. The Netherlands, the exact reverse. 22nd now, 11th in 10 years. Dull, structurally sound, improves the longer we hold it. Taiwan, an interesting one. 16th at 3 years, rises to ninth at 5 on earnings, then falls back to 19th at 10. That wobble is the entire AI question rendered as a ranking, and we'll come back to it on the next slide. One last detail worth knowing, and it surprised me. At the 10-year horizon, the pound and euro scorecard and my Australian one produces identical rankings. That is because the two factors that differ between them, diversification against your domestic investment holdings and market liquidity, both fall to zero weight at 10 years. Over that longer period, where you live changes how you buy the exposure, not which exposure is worth owning. Okay, three traps it's built to catch. Trap one: Korea and Taiwan are not a hedge against the AI boom. It's no surprise. They screen beautifully on external position and on earnings growth. But look at what those earnings actually are. They are the AI building cycle. If you buy them to get away from American technology, you have bought more of the same risk with a different listing on the ticket. Worse, both now sit near the top of the global valuation tables on a cyclically adjusted basis, according to Siblis research this last month. Friar wired this as a negatively weighted factor. If you disagree with me about AI, set that weight to zero in the sheet and watch both countries jump. That's the honest way to argue about it. Adjust the weightings and test it. Trap two: where a company is listed is not where its money comes from. We covered this on slide 2, but it's worth repeating because the scorecard cannot fix it for you. It grades countries. It cannot see that a given business earns three-quarters of its revenue in dollars. That's for you to check one ticker at a time. Trap three, and this is an uncomfortable one: spreading across countries falls hardest precisely when you need it. Longin and Solnick showed that correlations between national equity markets rise specifically in falling markets, not merely in volatile ones. 2001, Journal of Finance. So if the trouble Dalio is warning about arrives inside 3 years, and Friar thinks it will, geography will not rescue you. Only asset class and currency will. That's exactly why the near term weights lean so hard on the exchange rate and terms of trade rather than on simply being somewhere else. Okay, now, how do we actually use it? First, fix your own base currency before you touch anything. If you're not working in pounds or euros, the diversification column is wrong for you and needs rewriting first. As mentioned, let Friar know your currency and I can rewire it. Two, replace the data. Every figure in that sheet is a sensible mid 2026 estimate, not a sourced print. I flagged it in red so you can't miss it. Pull the real numbers from the IMF World Economic Outlook and balance of payment statistics, the OECD Siblis research for the valuation figures, and the BIS for real exchange rates. You have to do the work on that one. Three, and this is the one some people will skip, shake the weights. Change one weight at a time and see what moves. A conclusion that survives being shaken is worth acting on. A conclusion that collapses when you nudge one number was never a finding. It was your own opinion wearing a spreadsheet. Remember, the spreadsheet's weighted for Friar's thesis, which I assume you already know. If you don't, ask. Four, read the spread, not the position. Compare each country across the three columns rather than obsessing over who came first. And five, only then look at how to buy it. I've built in an access tab that covers the practical routes to the different exchanges. Okay, I'll leave that for you to read. Okay, four things to run through again before we finish. The data is indicative. Every input is a reasonable estimate and none of it is a sourced print. Thus, replace it before you act on anything. You find those figures, and that will help you understand it. It ranks, it does not forecast. Fry wants to make this clear, so I'll say it again. It ranks, it does not forecast. It's a deterministic model, so it has no error bars. Every input is a single point, a single number that with no uncertainty attached to it because you're getting a particular number, 36.7. There's no error in that. That's what you found, that's what you enter. Treat close scores as ties and be suspicious of any conclusion that hangs on a tenth of a point. Importantly, I need to say this, it's not advice. This is Friar's research is one of Friar's research projects. Nothing more. It's intended to introduce and that you do your homework using it so it balances, it fits your own requirements. That's the point of me building it. You can fit it to your own positions, and Friar is always happy to assist. Okay, Dalio has been making this argument for well over a decade. He has now put a number on it. He says most likely within 3 years, give or take 2 years on either side. That's a 5 year confidence interval. I think it's bullshit. And tells you something useful about how much precision he is genuinely willing to give. Fry will give you a forecast that this will happen within 3 years. Please remember, I'm happy to help, and I will attach the spreadsheet for whoever wants to download it. And yeah, ask me questions if you need. Okay.